Well, welcome everyone. I'm Scott Hodge, president of the Tax Foundation. On behalf of our sponsor, the Tax Institute at H&R Block, I want to thank you for tuning in for another of our Talking Tax Reform events on the most topical and interesting tax issues of the day. Well, today our issue is coronavirus relief legislation, tax code complexity, and the 2021 filing season. Boy, that's a mouthful, but there are a lot of issues here that are really interesting and really important. And the origins of today's event go back to our January event, in which explored the lessons learned from the 2020 COVID-19 relief packages, which were all very new at that point. And it was a very timely event because one of the challenges that Washington policymakers had was how to get relief to the right people in the most efficient and effective manner while trying to minimize the compliance burden on both taxpayers and the administrative burden on federal agencies such as the IRS. So when we asked our panelists back then, well, how did Congress do? Many of the panelists said, well, okay, but it's only January and the true test will be the April 15th filing season. Well, the April 15th filing season became the May 17th filing season. And now we can look in the rearview mirror and assess the process from the perspective of both the taxpayer and the IRS. And after all, when Congress makes these laws, it's really the IRS that is tasked or taxed to administer all of these new tax benefits in real time. And that's not an easy challenge to do. And so we're going to ask our panelists today, how well did the IRS do as a benefits administrator? We don't usually think of it in those terms, but in many respects, that is what the IRS has become. But also, how did taxpayers fare? The complexity of all of these new rules probably explains why so many people had to lean on tax preparers like H&R Block and others to help file their tax returns this year. And just as importantly, what can our friends on Capitol Hill learn from this experience as we look into the tax code of the future, but also the tax filing season of 2022, which people are going to have to start preparing for soon. Well, let's hope that taxpayers go through a similar exercise that we're doing today. They should be asking themselves questions like, is the tax code too complex, too complicated? How can the tax code be simplified and streamlined to reduce the compliance burden on taxpayers and the administrative burden on the IRS? And this is the biggest question of all. Is the tax code and the IRS the best vehicles to deliver direct aid? Are we simply asking the IRS to take on more responsibility than a tax collection agency is capable of doing? And let's not forget that in addition to the provisions that were created by the CARES Act, such as the emergency impact payments, or EIPs as we like to call them in Washington, or the recovery rebate credits, the IRS was already responsible for administering at least a dozen other credits, such as the earned income tax credit, the child tax credit, the child and dependent care tax credit, all three of which were expanded mightily in the CARES Act and other relief packages. And then we have the adoption credit, the American Opportunity Credit, that's an education credit, the premium tax credit for the Affordable Care Act, remember Obamacare? The IRS is also administering that. The healthcare coverage tax credit, the savers credit, the low-income housing credit, the plug-in electric vehicle credit, my favorite, and the residential energy credits, and the list goes on. Oh, and we haven't even gotten to all the deductions in the tax code that the IRS is also responsible for administering, but you get the point. And then people wonder why the IRS is a year behind in completing the 2019 filing season. Well, they have a thankless task. Well, you couldn't ask for a better group of panelists to tackle all of these issues and questions. So I'm really delighted to be joined today by Erica York, economist here at the Tax Foundation, who's been writing and studying on all of these issues for the last years. We've gone through all the permutations of these relief packages. My good friend, Nina Olson, executive director and founder of the Center for Taxpayer Rights and former taxpayer advocate at the IRS. And of course, she has this cool little award on her mantle because she was the recipient of the Tax Foundation's 2007 Distinguished Service Award. So I'm sure that's still somewhere on a shelf. And then, of course, our good friend Kathy Pickering, Chief Tax Officer at H&R Block, who's been really kind to appear with us in a couple of these programs and is just so knowledgeable. I learned so much from Kathy. Well, we got this great panel. Erica is going to kick us off today and kind of lay the landscape, and then we'll move on to Nina and then Kathy. So Erica, take it away.
Thanks, Scott. So as Scott mentioned, over the course of many years, the IRS has been tasked with an ever-growing list of administrative duties that go well beyond simple revenue collection, everything from poverty alleviation to education, housing, and healthcare benefits. And during the pandemic, the amount of relief administered through the tax code really exploded as Congress passed several rounds of relief legislation into law, totaling nearly $6 trillion of support. According to some calculations from the Committee for a Responsible Federal Budget, a little more than $1.8 trillion of that $6 trillion in relief was allocated through tax policy. And additionally, some changes that weren't directly administered through the tax code had impacts on tax liability as well, like enhanced unemployment benefits. Data from the Bureau of Economic Analysis shows that COVID relief directly increased personal income by $1.6 trillion over the course of the year. And that really indicates that the relief was largely successful, at least in the aggregate, in terms of preventing steep declines in personal income and helping to bridge people through the pandemic and economic crisis. But it also came with many administrative complications and hiccups that led to headaches and confusing experiences for taxpayers and people trying to access the benefits that Congress intended for them to get. So I'll just go through a quick highlight of the various packages that add up to the nearly $6 trillion and some of the headline policies in those packages before diving into some details about what we saw of tax refunds so far in preliminary data, and then some details on the unemployment insurance compensation. So first, the quick highlight: in March of 2020, Congress enacted an $8.3 billion package primarily to provide public health support right at the start of the pandemic. That was followed up by about $200 billion of the Families First Coronavirus Response Act. That expanded federal medical leave, created an emergency paid sick leave requirement, and provided tax credits against employer-side payroll taxes to help offset the cost of those programs, among some other changes. Then was the big one, the $2.1 trillion Coronavirus Aid, Relief, and Economic Security, or CARES Act. That provided robust support for individuals and businesses, including the first round of recovery rebates that were paid out as advanced refundable tax credits, an expanded charitable deduction, changes to the taxation of retirement accounts and student loans, enhanced federal unemployment benefits, including $600 increase in weekly benefits, and expansion to workers who normally wouldn't qualify, like freelancers or gig economy workers, among many other changes. Then in April 2020, Congress provided a plus up, or another round of the Paycheck Protection Program that was created in CARES, and provided some more healthcare spending to the tune of about $400 billion total. And then there was a really long dry spell that lasted until sort of the last minute. In December 2020, Congress included about $900 billion of additional relief in the Consolidated Appropriations Act to continue many of those programs that were first enacted in CARES, including another round of recovery rebates, a $300 boost to federal unemployment insurance, and allowing a look back to 2019 income levels for figuring the EITC and CTC in the filing season that was about to begin. In the interim, in August of 2020, a few executive measures were enacted that provided what amounted to about 4 weeks of additional federal unemployment benefits, as well as an optional payroll tax deferral for individuals. And then fast forward to March of this year, nearly $1.9 trillion of relief was included in the American Rescue Plan. That will primarily affect next year's tax filing season, but it did retroactively make changes that affected this year's tax filing season, including some changes to the taxation of unemployment compensation, as well as premium tax credits. So it's probably an understatement to say that the 2020 tax filing season was complicated for both taxpayers and the IRS, complicated by the pandemic and by those many relief packages that were passed into law. And that led the IRS to extending the tax filing and payment deadlines from April 15th to May 17th, both to help taxpayers and to give the IRS an opportunity to clear some of its backlog of returns that it had going into the filing season and to implement some of these changes. The IRS has made progress in eliminating that backlog from around 29 million returns left to process last month to under 17 million left this month. And so looking at the big picture of how recessions tend to affect the tax filing season and refunds, recessions tend to impact refunds for two reasons, both because taxpayers have lower incomes due to recessions and because tax policy tends to be a tool that provides stimulus that flows into refund amounts. So for example, we can look at what happened in the Great Recession. Total refunds rose above trend from about $250 billion in 2007 to $335 billion in 2009 before they remained flat for the next several years. The share of returns with refunds remained fairly stable while the average tax refund rose over that time. Preliminary filing season statistics for the 2020 tax year indicate that largely similar patterns are happening now from what we can see so far. So through the week of May 7th, about 126 million tax returns had been received. That indicated that about a quarter of people were still waiting until the last minute to file their returns, even though the deadline was extended. We saw that sort of same pattern of procrastination. But of those returns that were filed, about 116 million had been processed as of May 7th and nearly 85 million refunds received. And the refunds issued as of May 7th totaled about $243 billion, and the average refund size was up by about 3% to $2,863. So some of those same patterns seem to be happening in this season as happened in last recessions. But given that IRS processing backlog, as well as ongoing adjustments that are being made to returns, we don't have a complete picture yet. And so I'd like to talk about one of those adjustments that's underway due to a retroactive change of the exclusion of unemployment benefits before we'll hear from some of the other panelists about details about the credits and other things that the IRS and taxpayers have been dealing with. So lawmakers responded to the unprecedented increase in unemployment in 2020 with large increases in the payment of unemployment insurance benefits. Those UI benefits helped support American incomes throughout the year, and they're also considered taxable income. Just for a size of the scale, according to the US Department of Labor, before the pandemic, in the fourth quarter of 2019, about $6.4 billion in unemployment insurance benefits were paid. By the second quarter of 2020, that had jumped about tenfold to $64.2 billion, and that remained significantly elevated throughout the year. So to avoid an unexpected tax bill when filing their taxes, taxpayers would have needed to correctly withhold taxes from their UI benefits. For federal income taxes, a taxpayer can opt in to a 10% withholding rate, but that's not required. Additionally, taxpayers could have remitted quarterly estimated taxes throughout the year. Many taxpayers did not properly withhold and didn't save the tax that would have been owed on their UI benefits. And in some states, there were some hiccups. So even if a person had opted into that 10% withholding, in some cases, it didn't automatically apply to that new federal enhancement of $600 or later $300, which in some situations also led to unexpected tax liability. Even though the taxpayer thought that they had done the withholding properly, it turns out it hadn't been done properly. So partway into the filing season, in response to this, the American Rescue Plan was signed into law with a new provision to retroactively exclude the first $10,200 in unemployment benefits received last year per filer for filers earning less than $150,000. By the time that was enacted, more than 55 million tax returns had already been filed. And that led to a period of confusion where these taxpayers who had already filed didn't know if they needed to file an amended return or if the adjustment would be made automatically. After about a 20-day period, the IRS announced they would take steps to automatically refund that money, and that would happen in the spring and into the summer for people who had filed their tax return and reported unemployment compensation before the change had been made. Just last week, the IRS announced that they identified more than 10 million such taxpayers who filed their returns prior to the law's enactment and reported unemployment compensation. So those returns are being reviewed right now to determine that correct taxable amount of unemployment compensation and any adjustments to the tax that was paid and potential refunds for those taxpayers. The refunds for the simplest returns are set to begin this month in late May, while adjustments to some of the more complicated returns will stretch all the way into the summer. That's not the only complication, though. Because the exclusion will change a taxpayer's level of income, it can also interact with eligibility for credits and deductions, which may require a taxpayer to file an amended return in some cases. So, for example, on a fairly, you could call it straightforward or not straightforward return, the IRS can adjust a return for a taxpayer who, say, claimed the earned income tax credit, but now because of the exclusion would be eligible for an increase in their EITC and potentially a larger refund. But some, like taxpayers with children, would have to file an amended return if they didn't originally claim that credit on their tax return, but now because of the exclusion and their lower income level would be eligible to claim the credit. There are many other credits or deductions that taxpayers will have to look at to see if this interaction happened and if they might need to file an amended return. So not only is it a complicated provision because it was done retroactively in the middle of the tax filing season, it's also complicated because it interacts with many other individual income tax provisions. And so, as we see with many things, while the intent was good, the results in practice are even more complexity for taxpayers and for the IRS to administer. The IRS is working to solve the problem, but it really highlights a key principle of tax policy for lawmakers to keep in mind for future relief efforts and the tax code in general. Relief should be easy for taxpayers to understand and comply with, and for the IRS to administer. And when the underlying tax code is complex with many interactions, it can make that a difficult principle to follow. So I'll stop there and turn it back over to Scott.
Yeah, thank you, Erica. I think all of us are just shaking our head right now. And so we'll probably keep on that theme. Nina, take it away. Oh, you're on mute. There you go.
Yep, there we go. Thank you, Scott. And, again, it's such an honor to be here. And yes, 2000, the award was just wonderful. And it was great to be with people back then. Remember when we could be together? And listening to that and having spent the last year or so really, observing, but also working with taxpayers and representatives on issues pertaining to all of those pieces of litigation that Erica's really so nicely summarized. One thing that came out to me as I was listening to her was all of this legislation has basically put the IRS in a position of being reactive rather than proactive. It's getting instructions that it's having to react to and do the best that it can, given incredible circumstances, namely its own employees not being, on site, all wrestling with coronavirus and the pandemic consequences as well, getting back to speed after a huge shutdown. And now having more requirements in this filing season and also for the 2022 filing season with the advanced child tax credit, and then reconciling the third economic impact payment round. And when I think about if the IRS had had more time, some of the things it could have done to avoid some of these problems, I think that goes to doing things not condemning the IRS because of where we are, because of all these things coming on during the pandemic, but trying to look at this as, I keep saying, a proof of concept of if we wanted the IRS to do these things, how could it be done well and right? And that's what I'd sort of like to focus on by taking some examples. And one of the examples are the first two rounds of payments of the economic impact payment. So as I keep saying, it's near miraculous that the IRS got them out as quickly as they did under the conditions that they did. And if anyone doubts the importance of the IRS in terms of the economic health of this country, you just have to look at the last year, because imagine where people would be if they did not get those payments as quickly as they did. Now, I'm part of the group that actually took the court IRS to litigation several times, over their delivery of some of those payments. But nevertheless, for the bulk of people, they got their payments when they needed them. But here we now have the filing season where you've got two payments and people can't remember when they got their payments. And now you have to reconcile them. So a bunch of people have written on their returns the incorrect amount, and those returns go into the error resolution unit to be resolved. So the IRS has to do a lookup. That delays a 2020 return, which may mean that it's not going to be the return used for your third economic impact payment. And it may not be the return used for the advanced child tax credit. So the wrong person may be getting the advanced child tax credit because you're calculating it on a 2019 return, if there is even a return in the system from that year. And if you thought about it, if the IRS had had more time, because obviously its IT resources are being stretched incredibly thin, it would have, sent out a letter to people saying, before you file your, before the return filing season started, saying, here's what we have on record about the economic impact payments that were claimed to you. So they're plugging into their returns the correct amount. And that would have eliminated some of the error resolution. Now that's complicated by the fact that the IRS was still paying out the second round of EIPs up till January 15th. So that's not a possibility this year, but if you were being proactive, you would plan for that for the 2022 filing season. You would decide that on December 31st or the first week of January, when people are getting their W-2s, you'd send out a letter telling people you received this much for your EIP3. So that's what you need to put on your return for 2022. In fact, Congress has told IRS that they have to do that for the advanced child tax credit. Send out a letter at the end of the year telling people how much they got from the advanced child tax credit. So if IRS were being proactive, you would want them to also send out that letter for the economic impact payment. And it's actually in self-defense, because then that means at least preparers can get that letter, people, and it would be nice if you could even do a lookup, to see how much it is for the taxpayers that you have. But again, I'm not faulting the IRS for not doing it this year, because but just proactively. Another thing is Erica mentioned the look back that came in for the earned income tax credit, so that you could use the 2019 return or the 2020 income, whichever got you the most money. Now, this year, of course, it's a one-time provision, but they're working on it becoming permanent. And the thing is, okay, being proactive, you're being reactive this year. So there isn't any programming built into the return, submission pipeline that says, oh, let's do the look back ourselves for the taxpayer. Somebody used 2020, but they could get more income if they use 2019. Let us adjust the return. IRS adjust the return proactively, or check it proactively. Right now, it has to go into that dreaded place, error resolution, which is always sort of a holding place as people try to, IRS employees try to dig through, because if you go to error resolution, somebody's got to look at your return, and you only have a certain number of employees to look at those returns. If you get more returns, you're going to have a problem. So to keep them out of there, if there could have been some programming to prevent that. Well, you can't do it this year, but it's very likely the look back will be for next year and maybe years forward. So being proactive, program that in. Even say, would you like us to calculate this for you? Or we can proactively change it if we see you claiming the thing that's less favorable for you. That would also help improve the reputation of the IRS among people if they were doing things like that proactively. And what we did learn from the unemployment insurance was that the IRS can make what they call recoveries. That when things where you've got returns filed, but you want to make a systemic adjustment on the return, they can do that with their system. All last year, they were saying, no, we can't do that. But they learned how they did it with the Social Security, the dependents for Social Security benefits to get their earned income, their EIPs for their children. When they missed a deadline, they're doing it for unemployment. And one of the things that I want to see the IRS do proactively, Erica mentioned that some taxpayers are going to have to file an amended return if they didn't claim the EITC originally as a result, if they become eligible as a result of these adjustments. Well, I don't know why these taxpayers have to file an amended return. And I don't know why the IRS wants them to, because they have to look at those amended returns. And that's creating more work for itself. Why isn't there a way to systemically say to these people, based on the return that you filed and the children you put on this return and the adjustment we just made, you are eligible for the EITC. And here it is too. Or for taxpayers, as the EIC childless worker benefit has been really increased, why do you need to have a claim for that when you've got the W-2s, you've got the 1099 non-employee compensation? Next year, you're going to get the 1099Ks for the gig workers at $600. You have a pretty good picture by the end of the filing season as to what somebody's income is. Yes, there's always cash, but you know what? You don't know cash now when people actually file the return. You know, you don't know about that unless they put it down. You're not in any worse situation if you were to say, okay, you didn't claim the childless worker EIC, but based on what you filed, you're eligible. That's just a lookup table, and pay it out. And I think that all of those things, if the IRS had time, would be able to program them in. They are doable. It's just whether it has the resources and the time and the will to do it. And that sort of goes to my last comment, and then I'll turn it over to Kathy, whose folks are probably in the midst of having to navigate all this, which is back in 2010, I recommended, one, that the IRS change its mission statement to recognize that it had two lines of business. What Scott referenced as revenue collection and social benefits. And that was before even all the ramp ups and the changes to EITC and the expansion of it and the expansion of the child tax credit and now the advanced child tax credit. And the reason why I recommended that is because if you say, this is part of our job, then you start approaching your job a little differently. You don't try to shoehorn these social benefit programs, all the ones that Scott mentioned, that deal with family, right, and work, low income workers, into the traditional revenue collection stream and the focus on people who aren't paying the tax that they should. And so you would basically have different performance measures and different goals and different strategies and different communications and a whole different workforce that would work with this population that's getting eligible for these benefits if you really defined it differently. And they would also be thinking proactively, like, we know this population will probably miss things, so let's make it easier for them and let's program that in. And we don't have that now. It's shoehorned on top of all the other work that the IRS does. And I think if Congress and others are to continue down the way of using the IRS as an efficient overall payment mechanism, then you're going to have to make that change. And I think it's going to have to come from Congress saying that you have to do this, IRS. But I think that would eliminate some of the friction right now, where the IRS is actually doing two jobs at once, but it's really trying to do the second job with blind, like sort of just saying, we're going to do it the best we can, but it's got to fit into our old way rather than really thinking about new ways.
Thank you, Nina. And that's really interesting. That raised a couple of questions, but we'll get to those after Kathy. Kathy, as Nina mentioned, you and your team are probably working overtime and did throughout the filing system. How did taxpayers do?
Well, I think that you will hear some very consistent themes based on what Erica mentioned and then what Nina mentioned in terms of what we saw. So I'm going to kind of discuss 5 key points with regards to the recent tax law changes, the IRS processing issues associated with implementing those changes, and then just the incredible need for taxpayer service and support, self-service tools. And then I'll just conclude with some of the implications of these issues and recommendations for the upcoming 2022 filing season. So first, implementing retroactive legislative changes after the filing season has started strikes fear in the heart of all tax administrators, and H&R Block is right there with them. So let me just explain. On March 11th, the American Rescue Plan was signed into law. There was a high sense of urgency to move quickly to provide much needed relief. We were all caught up in that sense of urgency. And even though e-filing opened later than usual, it opened on February 12th, many taxpayers had already submitted their tax returns because they start filing in the first week of January. In addition to the third round of stimulus payments, there were 2 key provisions, which we've been talking about: unemployment, making the first $10,200 non-taxable, and forgiving the repayment of the excess premium tax credit for health insurance. So when this legislation was passed, it's estimated that roughly 10 million tax returns with unemployment income had already been filed. So there were 2 immediate questions that needed to be answered. First, if I've already filed, do I need to file an amendment? And second, if I haven't already filed, how long do I have to wait before the IRS has updated their systems so that I can file my return? These tax provisions are complicated, and many taxpayers who were receiving unemployment for the first time didn't understand that they needed to pay taxes on that income. So now changing it to say that they didn't have to pay on the first 10,000 of that income, that's great news, but it's still complicated and it's really confusing. So our recommendations in this area is put taxpayer communication as a priority and not as an afterthought. For example, developing a communication plan for taxpayers prior to celebrating the passage of legislation would better enable taxpayers to benefit from the legislation and would reduce the confusion and frustration. The communication plan would need to answer simple questions like, when will I be able to file a tax return with the new provisions? What should I do if I've already filed a tax return? And how will I know what the status of my tax return and my tax refund is? Pretty straightforward information. Difficult to come up with the answers, but these are the things that taxpayers need to know. Second, reconciliation is so much harder than it needs to be. The stimulus payments were advances of a tax credit, which needs to be on the tax return if they didn't get the full amount. So each round of stimulus payment had different criteria for eligibility and different amounts. EIP 1, $1,200 for adult, $500 for child. Round 2, $600 for adult, $600 per child. Round 3, $1,400 per adult, $1,400 per child. Then, if a taxpayer didn't get the full stimulus payment, they had to do a reconciliation. And there are many good reasons why a taxpayer didn't get the full amount. For example, they had a child or a new dependent. They had a reduction in their income. They never received the payment, or the thing that Nina highlighted is the IRS was processing on an older return, so the information was dated. At tax filing time, the taxpayer then reconciles the stimulus amount, and any differences go on line 30 of the Form 1040. If the taxpayer doesn't have an accurate amount for the stimulus payment received, there's a discrepancy. And that's what puts the return into, as we affectionately call it, purgatory, as it goes through the heirs processing review. Now, the IRS did send a notice, either 1444, 1444B, or 1444C to the taxpayer to provide the information, but it went to the last known address. So again, if they moved, if there was a change in the household, they didn't get that information. And many taxpayers just didn't receive the notice, or quite frankly, they didn't keep it. It's like, yeah, it's not money, I don't care. I'll think about that later. Quite often, there were discrepancies. We're estimating roughly 40% of the time. When that happens, the IRS has to manually review the return. They have the authority to adjust the return, but the volume of manually reviewing those returns created significant delays. And that was compounded with work from home, the shutdowns, and all of that the IRS was juggling as well. So now the funding of refunds, where there is the refund recovery rebate on it, really exceeds the normal 21-day timeframe. We're just seeing really extended delays in issuing those refunds. In similar situations in the past, the IRS has provided tools that taxpayers or tax software could access electronically that provided a lookup to verify how much they received. As example, there was a lookup tool for the recovery rebate credit of 2008, and there's a lookup tool for the first-time home buyer credit. So our recommendation is that for trusted third parties like top transmitters and security summit partners, enable digital capabilities to allow taxpayers and tax practitioners to electronically look up this information. The IRS thought they had a solution by providing electronic online account access. Unfortunately, this solution doesn't work for most. You're smiling, you're like, we are on the same page. Less than 40% of taxpayers are able to bypass the security requirements. So as a result, right now, there's 8.9 million returns that are still in manual review. Third, IRS processing is significantly backlogged, and IRS taxpayer service is at an all-time low. And this is not meant to be a criticism of the IRS, because they have done heroics in responding to all of this. This is just the reality of the situation that we're dealing with. As of May 8th, a week and a half ago, there were 16.9 million unprocessed returns in the pipeline. Now that's 10% of all filers, and most of those are refund returns. The level of taxpayer service is low. IRS is answering less than 20% of phone calls, and they are not answering the tax practitioner priority lines either. So the IRS has really lofty goals for improving taxpayer services, a lot of which is defined in the Taxpayer First Act. However, the timeline is incredibly long. So our recommendation here is the IRS needs to provide interim solutions that can provide relief while the IRS is transforming and modernizing their capabilities. Taxpayers and need self-service tools to provide visibility and transparency into the status of return processing. The IRS cannot handle the one-to-one questions from taxpayers, and tax practitioners can assist if they have tools and access. For more insight into this, ETAC and ERSAC, which are the IRS advisory committees, have issued detailed recommendations in their advisory reports for addressing the needs for transparency and visibility. Fourth, e-filing the 1040X, which is the amendment, is an important advancement, but it masks the fact that the amendment processing is still manual once it's received by the IRS. With everything that I've mentioned about the tax changes, unemployment compensation, EITC look back, and stimulus payments, the volume of amended returns is increasing. Just because you can e-file the amendment doesn't mean the process is automated, and that adds to significant delays. Our recommendation here, based on the current level of tax changes made and the additional legislation that's being contemplated, the IRS needs to plan for increased staffing to support a continuing high volume of 1040Xs, and also make public their roadmap and approach for automating 1040X processing. And then fifth, a taxpayer thinks about their federal and state tax returns as one holistic event. IRS and states simply do not have that perspective. So if we use the example of how unemployment adjustments will be handled at the IRS, we know that some states intend to do a corresponding automatic adjustment for their taxpayer, while other states will expect their taxpayers to file an amendment. So how will taxpayers know how and when to file the state amendment, or when to expect an automated refund from the state, and how much will it be? So here, our recommendation, the IRS needs to look at the taxpayer experience holistically and work with the states to develop taxpayer communication plans to answer some basic questions like, will I receive an automated state tax adjustment? And if so, how much will it be and when can I expect it? Or if I need to file a state amendment, how will I know when the IRS has made their adjustments so that I can proceed to file with the state? So in conclusion, as we look forward to the implementation of the monthly advanced child tax credit payments, we can anticipate that the same questions and issues that were experienced with the stimulus payments will recur and will then be repeated each month. How much money will I be getting? Where is it being sent? What can I do to change it? And how will that impact next year's tax return? So the things that are needed are, first, communications plan to proactively anticipate and address these questions. Second, self-service tools to provide transparency and visibility to the status of the payments and the processing. Third, electronic lookup tools to facilitate reconciliations. And fourth, increased IRS staffing levels, because the current backlog will not be quickly resolved, and the upcoming payments will add to the demand for taxpayer service. So thank you, and I'll turn it back to you, Scott.
Thank you, Kathy. Well, I don't know whether to just kind of give up and go home now, or where do you begin? It sounds, I think by all accounts, these issues are gonna be with us for the next year or more. I'm not even sure. We got some interesting questions, and some of them are a little more technical. We have we'll start sort of with some of them that have come in over the transom. And we have a lot of divorcees that appear to be listening in, and they're asking, I don't know, Kathy or Nina, how will the IRS deal with children in partial custody of each parent throughout the year with the monthly advanced tax credits and some of those issues? There are lots of issues that are with these advanced tax credit. That was one I would never have thought about, but gosh.
Well, I was just speaking with some folks from IRS yesterday, and this is an issue that comes up a lot because children move between households. We know they move between households from year to year and also within years. And the child tax credits are geared to the 2020 return. And if there isn't a 2020 return, you look to the 2019. Right. I do know that if a 2020 return is held up in processing when the IRS is making the decision to make that initial payment in July, when it has its cutoff date, it will look at the 2019 return, which may be the wrong information. And then it will, once it's done with the processing of the 2020 return, make an adjustment based on the 2020 information. So you may see someone getting the wrong payment, like if you filed married filing joint in 2019 and there was an account associated with that return, the advance credit may go into that account. But then when a new 2020 return comes in where the custodial parent you've separated and you're head of household now for 2020, my understanding is when that return is processed, there'll be an adjustment for the next advance payment and it will go based on the 2020. Now, whether that's really going to, I mean, that's what they're trying to do. If now there's supposed to be under the law an ability to update your, for new children that were born since your 2020 return, your filing status has changed, et cetera. The IRS has said they won't necessarily have those capabilities ready until September or so. So they're rolling stuff out as it happens, but it's not clear whether they will disallow the entire payment. Like if the 2020 return was married filing joint, and now you're coming in saying for 2021, I left my spouse and the children are with me, and so I should be getting the full payment. It doesn't sound like they're going to do that. They're probably going to split the payment in two and give one half to, you're basically updating, send my share of the joint payment to this account, and you're still paying the other half to the other person based on the 2020 return. This is,
and just to layer onto that.
Yeah.
I mean, Nina, I'm sure when you were at the Taxpayer Advocate Office, you just saw this, but for our preparers on the front line, oftentimes this is one of the most heartbreaking issues, because especially with newly divorced parents, very emotional, very acrimonious. And it really relies on the parents being able to work effectively together to, ensure that the money is going to the place that it is, because the IRS just doesn't have the systems and the capabilities to keep up with that. And so these are some of the most heartbreaking scenarios that we see. And we certainly saw this with the stimulus payments as well. The payments went to the other parent, and there's no negotiation that gets that money distributed to where it was, where it was intended to go. So it's a very painful part of these processes.
And that goes to, I really feel that goes to my recommendation about having a family and worker benefit unit, because then you are focusing on these issues and at least getting communication out, and then maybe being able, based on these patterns that you're seeing, making recommendations about how the law should be changed, how the definition of the family unit should be, more expansive. I do feel that, and I've been trying to counsel everyone, like, don't condemn what's happening with this 6-month test. Let's learn from it. And we may learn we can't do it. We may learn we can do it, but in order to do it well, we have to have definitional changes. We may learn that we have to have technology. We may learn we just need to give IRS more time to do better, more programming that might solve things. But we're going to learn a lot, and we just need to take a deep breath, as painful as it is.
We will absolutely learn a lot. That's a great question, though, Scott.
Yeah. Well, Erica, let me get to the political question. As long as we're on that issue with the advance payments, what are you hearing about, and we got a question from our audience, about this becoming a permanent thing? I mean, we are going to be going into the 6-month test, but there seems to be political energy about making this permanent. What are you hearing on that, and what's that look like?
Yeah, so there's already included in President Biden's American Families Plan a proposal to extend the enhanced child tax credit for 4 years through 2025. So I think we'll at least see that much included in any legislative efforts that materialize this year. There's also a push, of course, to do more than just that 4-year extension to make it permanent. One interesting sort of interaction that comes up with permanence versus that 4-year extension is that after 2025, The 2017 tax law's expansion of the underlying child tax credit expires. So in terms of the budgetary impact, the cost of extending it beyond 2025 becomes much higher than this 4-year extension. So that's one of the political considerations that lawmakers are dealing with, is the cost of this expansion. We've estimated that permanence for it over the 10-year budget window would cost on the order of $1.6 trillion. A lot of that comes in those out years when the underlying child tax credit is scheduled to shrink back to its pre-TCJA levels. So I do think there's support for at least extending it 4 years. There's obviously support in some circles for making it permanent, but the question is how do you pay for that?
Yeah, Nina, EITC and some of the other credits are legendary for what we euphemistically call improper payments. What are we in store for with all of this now? I mean, EITC improper payments are somewhat 25% of all of it, somewhere in the neighborhood of anything from 15 to 25 billion a year. And now, of course, we've opened up this Pandora's box of refundable credits, et cetera. What's that going to look like? I mean, is the taxpayer advocate or whoever scores these things, or what's it going to look like this year?
Well, you know, it's the combination GAO and Treasury. Everybody has reporting obligations, you know, for improper payments. And, you know, I'm very concerned about the advanced child tax credit. Even just the scenario that I just described contemplates that the money will go to the wrong person because we're doing it on a look back on 2020 and things change by then, or even 2019. So we know that that's going to happen. And Congress built in a safe harbor saying, okay, we know it's going to happen. So if it's below this amount, we're not going to even try to take it back, because this is just the problem with the mechanism that we're using. What I've tried to think about is there another way of doing it where you wouldn't have these same issues of improper payments, given that the families change from year to year? And I'm not entirely convinced that if you put it in Social Security or somewhere else, you wouldn't have the same problem. You know, you'd get current information and pay it out like for 1 month, but then maybe the child would move for another month, and then you'd get it into the wrong place, and that would be an erroneous payment. So I'm not sure. I think you can get rid of some of the improper payments by maybe being a little bit more flexible about who qualifies to claim the child. There's some definitional things we can do that maybe better reflect the population that we're working with and their household characteristics. We've got lots of research about that now. But I think we have to accept that anything that has to do with families, if it's based on past year information, there's going to be a fair amount of improper payments. I will also say this. The law is so complex, and because family structure changes, 1/3 leaves or comes in every single year. So there's no like learning curve where you've made a mistake this year and then you get to learn from your mistake for the next year, because 1/3 of you are churning in or out, you know. And that goes to Kathy's point about education, and education in a way that taxpayers actually can understand it. So just posting things on the website ain't going to do it. The IRS actually needs an appropriation for paid advertising. It used to do that years ago, where it can actually get out over the airways to people in the times that they're listening to television and radio and social media, to get good information out, and do a learning curve in that way. And we haven't been able to experiment with that for a while to see how effective that could be. But obviously advertisers do it all the time, so it must be pretty effective.
Yeah. Kathy, we got a couple questions on UI, and I don't know whether this is in your bailiwick, but a couple in the same genre. Does the exclusion for UI income extend to 2021? And then what happens if a taxpayer receives UI income in both 20 and 2021? What happens to taxpayers in states that have opted out of the federal UI bonus? Will they still be eligible for the exclusion? What do you think?
Great questions. And it just really speaks to the whole complexity, of this, right? Because there were so many moving parts and pieces, and everybody's meant to really be able, the desire is to give people that supplemental income so that they can, make plans and take advantage of it. And then when things are moving, and is it taxable? Isn't it taxable? When does it expire? And how does my state treat it? It makes it virtually impossible for someone to make, good plans around how to adapt to this. And I mentioned this briefly in my comments, but just to really reiterate this, COVID put so many people on unemployment that would never have otherwise had experience with it. For people who have received unemployment in the past, you talk to them and they're like, oh yeah, no, make sure you withhold taxes. You get that tax bill once and you're never going to make that mistake again. So we saw a lot of parents counseling their children. If you're going to take that unemployment, make sure you're withholding taxes. But if this is your first time and you're trying to make a trade-off between, I need as much money today in my pocket so that I can buy groceries and pay rent, versus I don't want that tax bill in the future. If you don't have that experience, you really don't have the foundation for making the decision. And this is just so much of what we saw. So these are just all the puts and takes. And then, trying to reiterate, now you need to also understand in your state what the situations are. I think that Nina and Erica also alluded to this a little bit, but the states were just getting trampled with trying to update their systems to be able to issue the unemployment and take advantage of the federal supplement and and get those payments out. They were very delayed in being able to respond to the kinds of demands. And we certainly saw that in a few states, there were a lot of fraud issues, and there was so much, identity theft of people making invalid unemployment claims that then flowed through and manifested as people were trying to file their taxes. They became aware that somebody had filed for unemployment using their information that they had no idea about. So there was just this whole other layer of complexity associated with identity theft as well. So it's really, if we've got another hour, I'd like to spend some time on that.
We are up against our deadline, and maybe close on the technology issue. Obviously, H&R Block, yeah, you're a taxpayer service, you're a technology company in many respects now. And maybe just a round robin at the end here, how much is technology now almost the salvation for this, whether it's at the IRS, whether it's with companies like H&R Block and so forth? I mean, 75 to 80% of us are using either prepared filers or preparers or some sort of software to file our tax. Is that the solution here? Is that the only?
Yeah, I mean, over 90% of taxpayers use some form of assistance, whether it's a tax preparer or just software. And so there's a lot of ability within, that side of it. But what's missing is the IRS. They're still in many cases operating on very outdated technology, and AIRS is one of the worst examples of that. It's a very old format system. Yeah. And so you can only be as nimble and quick as, the weakest link, there. And so what's hard is that taxpayer expectations have changed because digital enablement is so prevalent now. We can get anything at the click of a phone. And so that disconnect between what you're able to experience in the rest of your life and then what you experience, when you're filing is so vastly different that it creates a lot of frustration. But the IRS, I mean, these technology changes don't come quickly.
No.
There is just a long roadmap for what it's going to take to update the systems, and the needs are here right now today. So that's why there needs to be kind of some short-term, point solutions while they're building for the future.
What's that look like? How many billions are we talking about?
Well, I mean, it's going to be 10 years for them to really, at least, to turn around the fundamentals. But even now, I mean, the commissioner talks a lot about using artificial intelligence to go after people who, they class as tax evaders. But, to give the example that Kathy used about the 1040X, you get it e-filed and then it's manual processing. Well, you can use artificial intelligence systems today to identify whether this is a return you really need to look at or you don't need to look at, and then let that little amended return go happily on its way. Those are all things that could be built into the technology on the service side that I don't hear a lot of conversations about, that would lessen the workload for people in the IRS. And then the other thing that I would just caution is, no matter how spiffy the IRS gets with its technology, this is the IRS. So when you get a notice from the IRS saying we can garnish your paycheck or levy on your bank account, a lot of people aren't going to be comfortable with just signing on to their online account if they can get on. They are going to want to talk to a live human being to say, are you going to do this? Wait, this is not, they want to hear a live human being saying, no, I've adjusted the account. We're not levying on it. Because the IRS can do things that Amazon can't do, that other online retailers can't do. So we have to also staff for the customer support side, as well as use technology on the customer support and service and processing side to eliminate some of the rework that the IRS is drowning under now.
Yeah. Erica, any last thoughts from the economist perspective?
Yeah, I think just big picture, wrapping it up, the intent of so many of these policies is good, but that has to be reconciled with the reality of the IRS and its service levels right now, as well as the underlying complexity of the tax code. Something like, oh yeah, we should avoid surprise tax bills on unemployment insurance. That's a great idea. Let's go do it. Sounds really great, but then you see how that plays out in practice, and it's a complicated nightmare. So I think taking a step back and looking at real concrete ways we can simplify the underlying tax code, in addition to these technology and service improvements at the IRS, is something that's completely necessary and should be done before we have to get into crisis mode again, whenever that may be happening next.
Well, thank you, all three of you. This has been a fascinating, maybe a little bit dejecting conversation, but hopefully something to build on, and hopefully some messages to Capitol Hill too on what they need to do to make this right. Thank you all for joining us today, and this has been recorded, and we'll have that posted probably in a day or so, so that if you miss something and you really want to go back and look at it, that'll be available to you. And keep your eye out for notices for future events like this. We're always trying to stay on top of the key issues in tax policy and economics, and we want to bring that to you with some of the best experts and thinkers on these topics, so that you're informed as we go along. These are important times. We want to make sure that you're on top of them. So thank you for joining us. Again, I'm Scott Hodge, President of the Tax Foundation. Look forward to seeing you down the road, and be safe. Thank you very much.
Thank you.